Hey, folks, let's see here. How's it going? All right. So it's your old buddy Josh. It's let's see what time. 7:59, live and in studio, in person with our best friend Splinty. I got a new best friend, Splinty. So thanks for joining me here today. 7:59 at it's a hot day here in Georgia. I haven't really done anything because you can't do anything. Hey, what's going on, JD? You can't do anything when you got a splint on because they're worried about you sweating up in here where my right shoulder is, and they don't want you sweating and getting stuff in your incision. And so for the next 6 weeks, we're gonna be what's up, Renee? For the next 6 weeks, we'll be sitting here with this thing and can't really type, can't really do much of anything. It's my wife was a trooper though, man, kicking butt and taking names today. Actually, since I've been down and out, so it's awesome. Hey, what's going on, Tina? Yeah, no, right on. I was going to talk about that a little bit about the article I was talking about. Retirees should spend more money. We're going to talk about that here today because I think it's important for people to understand that. Anyway, so for all you men out there, well, fathers, I guess, in particularly, happy Father's Day to one and all. And nothing better for me than being a dad. Rich, AJ, A. Turner, right on. It's just funny. My oldest daughter texts me from Europe because she's over there with Georgia Tech, quoting from The Simpsons about no beer, no TV, make Homer something something. So do any therapy, yeah. Edward Rooney. Edward, where are you from, man? Edward Rooney. That's my wife's maiden name. They were initially from, I want to say Galway, if that's where you originated from. Marie? Yeah, I feel all right, Marie. It's painful. Boston, right on. Okay, that's shocking there. A Rooney in Boston. I'm amazed to hear that. Anyway, Jay Snyder, right shoulder surgery 4 months ago. Are you up to snuff now? I was just thinking about it. I was just telling my wife, I don't know how these professional athletes deal with that. Because they literally are a machine when it comes to athleticism. They can't take a break or anything like that. Well, not much of one. And I don't know how when, I remember when Wes Welker, he was playing the Texans in the playoffs, I think, a few years back. And he busted up his ACL, and he was out for the playoffs. If memory serves, I can't remember. I just remember that you can't do anything. I mean, you can't run, you can't lift weights, you can't do anything. And that's what your whole point of being is being an athlete, and you can't do anything. I mean, what? Just because I feel like crap. There's no. I mean, it hurts a little bit. I don't feel that bad. I don't feel good because I haven't worked out. I haven't walked. I haven't worked out. I haven't done anything. It's freaking hate it, man. Anyway, so it's just, I don't know how these guys do it because I'd be depressed. Like, what is that? Durant, he busts up his ACL. That's a pretty significant injury right there. Kevin Durant, I don't pay a whole lot of attention to basketball, but I don't know how these guys do it, man, because that's your whole life is revolved around sports. And if that your body is to malfunction from whatever, you're in a world of hurt for sure. Yeah, that's right. Rich says, didn't realize how much you use your shoulder. Exactly right. How much you use your shoulder for whatever you do until you can't use it anymore. Actually, it's funny. My wife's got a guy. Yeah, I was gonna say JD said he had his knee replaced 9 months ago. My wife's her boss at her job was saying he couldn't walk up the stairs, and now he's like, "Look at me, he can jump around like a crazy man." It hurt like hell, but he's like in a completely new realm. So that's awesome. That's what I'm hoping. Same thing. I have my shoulder here. Better than before, says Jay Snyder. Moved it and did a therapy stronger than when I was in the Army. Yeah, that's good. That's what I'm hoping for, man. I'm hoping for it. I'm hoping the pain, because there's always there a lingering pain. You just feel it's just a matter of time. It's sure as hell. Boom. What was your MOS, Jay Snyder, in the Army? What unit were you in? I guess that's probably the better term. Let's see. Anyway, so a couple of things as we're taking off here. Happy Father's Day. So my daughter texted me something about The Simpsons. So here's the first question for you guys. You ready? Whoever wins this wins the internet for the day. Homer says to Marge, he has types on his typewriter. It says "feeling fine," and Marge says, "Oh, that's refreshing." And then lightning goes off, and she sees it says, "No beer, no TV, make Homer something something." So who knows what the something something was? Whoever wins and answers that, no beer, no TV, make Homer something something. Yeah, 21B, fourth ID and third ID. Right on. All right. That's what Homer. So anyway, my daughter texted me that, so that's pretty cool. My youngest daughter, who's my second oldest, said, surprisingly, my jokes can be kind of funny. That's good. And then my two boys, we put together an NHL puzzle today, 500-piece NHL puzzle. We just finished that sucker up about 2 hours ago. So the life of a dad. My wife put some New York strips on the grill. Had some, what did I have for dessert? Some mint chocolate chip ice cream. Man, I don't get how these people are so up in arms about living in the United States, man. I was just reading an article about these crazy loons out there who just hate the U.S. I don't get it. I'm sitting here thinking, man, Dana, you sent pictures of Casco Bay to my email? No, I did not, man. That's nuts. Yeah, I hope you send them. I didn't get any. Are they, whoa, I'm going to check right now. They might be my spam. Anyway, so happy Father's Day to one and all. We need more dads out there. That's for sure. And Dana, I am going to look. I'll have to do it later. And if you're thinking about being a dad, I highly recommend you do it. I highly recommend you do it for sure. Go crazy. That's right. Steven Rivera, number one. Right on, man. Here in the beautiful 29 Palms. Right on, man. 29 Palms. Is it beautiful there? Go crazy, says you guys. Exactly. You win the internet. Steven Rivera, he wins the internet for knowing what Homer says. No beer, no TV, make Homer something something. And Marge says, go crazy. And Homer says, don't mind if I do. Blah, 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 blah. Anyways, you just got to kind of be there. Okay. Sent them snail mail. Okay, gotcha, Dana. Right on. I haven't seen them yet, so I'm looking forward to that very much. We plan on taking a trip to PEI next year. I'm stoked to see that. So, all right, what was I going to say? So I did a video today, and all you military, got Dustin out there in Marine. We got my man Jay Snyder, who was a 21B, 21 Bravo combat engineer. That's a tough flipping job there, man. I don't know what an FSO, it wasn't a foreign service officer. What the hell was that called? Field, I forgot, but they were attached. Yeah. There you go. We got, I don't know what 0351 is for the Marine Corps, Steve. I'm not sure what that meant. Is that a MOS? Do they call MOS in the Army the same? OS too? Yeah, I'm not sure what that means. I guess, yeah, that must be the MOS for Navy, Marine Corps. Okay, infantry. So if you're in the infantry and the Marines, it's an 0351. In the infantry and the Army, it's 11 Bravos. That's interesting. Okay, so we all learned something here today. Very worthwhile financial planning. Marietta, Wisconsin. Yeah, right on, Pete. My pleasure. So I want to talk about this because I think it's incredibly important. I did a video on it. It took off like crazy. I already got like almost 2,000 views, which is nuts. This guy, Meyer Statman, I think, M-E-I-R, Meyer, and I think he's Israeli, as for a matter of fact. We've got a lot of good talent from Israel folks coming here and being professors and whatnot. Desolate out there in 29 Palms. Oh, yeah. No, absolutely. And it's interesting because that's where Kahneman was, Daniel Kahneman. That's where Amos Tversky was. A number of people from Israel come over to the U.S. and do great, great academic work. Unfortunately, the stupid BDS thing, they're being discriminated against. No other way around that. So my M-E-I-R, and I have a good friend of mine who's an Orthodox Jew. He used to tell me how to pronounce the names of these various Jewish names. And I don't know if this guy's Israeli or Jewish. I don't know. But I thought it was interesting because his take on this article in the Financial Planning, Journal for Financial Planning, was that retirees are not only not spending enough, they're doing it while they're worried about it. They're engaging in self-poverty, not like Mother Teresa. Mother Teresa and others engage in self-poverty because they completely believe that, if they had more, they needed to give it away. That was their call of life. But a third of these people, according to what this guy's, his base of rule of thumb is, a third of the people are poor by their own, not by choice, but just their nature. A third are poor by fault, by their own fault. And fault's not the right word, by their choice. And then a third are doing it right when it comes to retirement. And I actually tend to agree with that. So his argument is that the third of the people that are poor are probably not going to hire a financial planner, but the third of the people that are poor by their own choice and are, running around looking over their shoulder, waiting for the doomsday to come, that's the people that need to be, spoken to in a matter of that says, forget this stupid retirement crisis thing. It's not out there. And I find that to be absolutely anecdotal evidence myself. I can't tell you how many times I've had this with clients who just say, like as in my video, I was telling you about the couple up in Cherry Hill, New Jersey. The woman wanted to buy new shoes. The husband, he wasn't a dick about it, but he's just like, you could just tell there's some tension there when she wanted to buy new shoes because he's like worried about running out of money because that's where he came up. I think his was Polish. I think they fled the commies or something like that in the early 30s. They moved to Camden, New Jersey, and then they fled that when the riots hit in the late 60s, and they moved to Cherry Hill. And I think he was very, very nervous about, being poor because his background was fleeing the communists, fleeing crime and whatnot. And yeah, they had well into 7 figures, no debt whatsoever, pensions as far as the eye could see. She was a retired New Jersey school teacher, and yet buying a $75 pair of shoes at the Cherry Hill Mall was an issue. And it's sad. And so because of that, it's what my man Mayor was stating was that, look, those third of the people are doing it right. They probably need help tax planning and all that. The third of the people are too poor. Not much you can do about them anyway, but the third of the people in the middle there who are making basically claims to poverty without even thinking about it, they need to be read the Riot Act that it's okay to spend. And it's interesting because the issue is the evidence now is so overwhelming. A guy on my Facebook page, Ken something, I forgot his last name, sent me a couple articles which I've read this afternoon. On top, you can't see this, but I got 4, 5, 6 windows open with different research studies from the Human Health and Retirement Survey, HRS, obviously BLS I use all the time. There's another one, a big government one I use that shows you that people don't run out of money to the extent that we think. And it just ticks me off. I'm not going to lie to you. It's the fear mongering in the industry, no different than the climatistas who say CO2 is going to kill us all. I mean, you can just look back. We've been talking about this for 100 years. The Montana glaciers are going to melt. They've been saying that since the 1920s, and yet here we are today. And ironically, they just started pulling the signs off that said by 2020 there will no longer be a Montana glacier because they know it's silly. It's the fear that these people use to take the ignorant and scare them with a stupid hockey stick. Power crisis. I'm like, man, shut the F up. We live in the United States of America. The only crisis here is that we're affluenza. We have so much wealth, so much that we don't take it for what it's worth, and we take it for granted. It's nuts. So anyway, it ticks me off, and I don't want that people to be like that. I'll go down swing as much as I can, saying this is nuts, man. And so anyway, going back to one study I was reading, I forgot what it was. They're using, and I post this on the YouTube channel and on my Facebook page, where I said, I'm not tired of winning yet, because the JP Morgan, whatever it is, they show the exact same thing I've been talking about since I started this channel, that retiree spending goes down. Actually, but it's interesting too, because what the prognosticators of spending say is that you're going to spend 70% of your last year's pay in retirement just at each and every year for inflation. Now, I don't know if you know any police officers. We got lots of Leos on here, but in the old days, I don't know if they still do this. And I'm just picking on police officer time being, because I know it's all over. But the last 3 and the high 3, you ever heard of the high 3? You bust your butt with overtime in the last 2 to 3 years of work, because your pension is based on those last 2 to 3 years of work. So you're working 80 hours a week in order to get a pension that's based on your last 3 years of labor. All right. So what happens now is you say, okay, I'm going to work my tail off, and I'll have $120,000 earned income. Well, I'm really only making a salary of 80 because my pension will be based on that 120. I hope that makes sense. Well, it's the same thing here with retirement planning. It says we're going to use 70% of your final year's pay and you're going to say that is what you're going to need. The same flipping article that says that says people spend like drunken sailors, part of my Navy and Marine Corps brothers and sisters out there, because it's a joke, right? We can all say it's a joke. You can say drunken infantrymen if you want, I don't care. But we're going to say you're going to spend like a crazy man the last couple of years of retirement, a couple of years before you retire, because that's the last time you're going to have this income coming in. So to say we need to replace 70% of that income and adjust it each and every year for inflation is flipping nuts. All right. So, all right, let's go down here. Let's see we got any questions here. So I'm waiting on Dana, is that right? Yeah, pictures of Casco Bay, which I'll share with you guys, because Casco Bay is basically awesome. Tel Aviv is great. Never been there. Oh yeah, I'm not Jewish. I certainly want to go. Tina says, do I call myself a financial planner or advisor? I call myself a financial planner for sure, because I think the financial advisors, that market, that is such a wide berth of who can be called a financial advisor. A lot of financial advisors, Tina, are nothing more than investment consultants. I'll never forget when I first, this is probably back in 2003, a friend of mine became a financial advisor with Wheat First Securities or something like that. I can't remember what it was. Wheat First Securities, and it said financial advisor, and he just basically sold people mutual funds. And I was like, he was a nice guy. I said, you're not really advising on financial issues. You're just selling mutual funds. So I don't call myself a financial advisor. It's a financial planner. Hope that helps. Second, I did want to talk real quick too. I did a video on this yesterday. The number one question to ask a financial advisor or planner or any guy, insurance person, I don't care, whoever it is you're dealing with, who you think is going to help with your financial planning, just ask them this one question. A 60-40 portfolio is traditionally what we've used, and that's where we derive the 4% rule, a 60-40 portfolio, 60% in U.S. stocks, 40% in U.S. bonds. Do you, Mr. Prospective Financial Planner, Advisor, Investment Guy, Insurance Guy, CPA, you name it, do you think that 60-40 portfolio will give us the same rates of returns going forward as we've had historically? That's the one question to ask. Because remember, if you're interviewing a financial advisor, that guy or lady should be asking you the questions, not vice versa. There really shouldn't be much you ask him other than how much you get paid. Literally, that's it. Other than that, the only other question you should ask is that one right there. Now, I'm sure I can come up with a bunch of other questions to ask to see if this guy knows what the hell he's talking about. But that's the one question. And the reason, again, for that is because the old days of 60-40 portfolio with stocks, 60% of the portfolio stocks gave you 10% rates of return. Well, now we're projecting, I use 7.5. The old days where the 40% of bonds gave you 5.5 to 6% of return. Now I'm using a 2. All right. I actually, my planning software, I'm still using 3 for planning because I haven't reduced it yet with the rates that have gone down so much. So if a guy or a lady is still saying we expect a 60-40 portfolio to give you about a 7 to 8% rate of return, you got to ask how they're getting that number. Where is that being? How are you driving at that? Because I literally don't get it. The only way we can get that is if the stocks, which represents 60% of the holdings, incredibly outperform. We're talking huge increases in price to earnings in terms of the growth of the stock, gigantic leaps in earnings growth. I mean, just stuff like we've never seen. Because to go from 8, all right, so if let's just use 8% rate of return. If I'm using 8% rate of return for the 60% of the portfolio that's in stocks, you times 0.8 by 0.6, and you're going to 0.08 by 0.6, and you're going to have 4.8%. So the stocks are going to give me a 4.8% total return of that portfolio, even with an 8% year-over-year growth rate. Well, the bonds aren't going to give me anywhere near that. The bonds are going to give me about 2. No, not even 2. It's going to be about what did I say? It's less, about 1% is what it's going to be. But it's actually 0.08%. So it's less than 1%. At 2% 10-year treasury. So bonds are going to give me less. So between even an 8% rate of return on stocks, a 2% rate of return on bonds, which is what you're getting now, that portfolio right there only gives you 5.3% a year. That's it. That's before inflation, by the way. So then you got to factor how where is the give here? Well, there's no give on bonds. Bonds are what they are. They're 2% for the 10-year treasury, maybe 2 3/4 for the 30-year treasury. That's it. There's no give there. So you're not getting anything on bonds. The only way to get back to that 7 or 8% is for the stocks to increase their growth significantly, where we're talking 12, 13, 14% a year rates of return from here on out. And that no one's you can't, even Dave Ramsey would say that's crazy. And we all know Dave, he thinks 12% is easy. Just hire one of his financial advisors. You can't do that. So anyway, that's the number one question to ask is, do you think the old days of 60-40 portfolio, the returns going forward will reflect that similar as what we used to? If the answer is yes, I'd say get the hell out of Dodge. Or if you want to be nice and give them a second chance, say, how do you get that number? I want to know, how do you get that number? If the answer is no, well, that's good. I'd say, how come? And find out what they say. If they say, well, because the markets are doomed, or I don't know what else. I mean, what else they could say? Trump is starting his trade war with China, or Biden is, friggin' going to sniff someone's hair. And I mean, whatever. You can say whatever you want to say, but at the end of the day, we need an answer to these questions. I was reading an article just this afternoon again, too. A guy was saying, who I follow quite a bit, that he thinks by the 2020, the 10-year treasury. This is a guy who runs money, by the way. He thinks the 10-year treasury is going to be paying 6%. I said, oh my gosh. If the 10-year treasury goes from 2 to 6, that's a decline like we've never seen in the bond market. I mean, we didn't even see that in the 1981, 1982. And he's a pretty well-known guy who runs money. And that's an aggressive prognosis, he says, but he thinks there's a good chance the 10-year treasury will be yielding 6 by freaking 2020. All right, so here's let's see what we got here. It's like, do you realize how far down the price of bonds has to go for that yield to go up to 6? But of course, he'll say, "Oh, because the government has manipulating or something like that." I said, "Okay, I mean, even if that were true, we'll even grant you that. Let's just grant you that the government somehow is in there manipulating the prices of bonds, whatever." All of a sudden, out of nowhere, they're going to say to all these insurance companies and pensions companies and governments who hold treasury debt, you're going to lose, 75% of the value of your bonds in 18 months' time? I mean, come on. People they say stupid stuff all the time. Like, that just doesn't make sense. Even if the government maintained the price of bonds, even if I granted you that, for the bonds to go from 2 to 6%, that is a 300% increase in yields, which means we have to have a 75% decrease in price. No government is going to do that. I'm sitting here thinking, and all these financial advisors on the various websites I read say, yeah, kind of makes sense. I can see that. I'm like, are you flipping insane? If you're running, see all the tax increases that the state of Illinois just passed, right? Do you think the governor of Illinois is going to sit there, the Democrat, and the governor of Texas, a Republican, a liberal and a conservative, are going to sit there and say, yeah, go ahead and take 75% of the price of our bonds holding that we have. Just watch them go away overnight because Jerome Powell wants to stick it to Trump. I mean, I don't know. Let's just deal in reality, please. Oh, yeah. All right. Sorry about that. All right. So here we go. Michael, I'm a government employee, spouse's Missouri teacher. Statistics say I'll die first. Yep. Why must my wife not get my Social Security, but someone else's wife, if eligible, if not a teacher? Because of government pension offset. That's what it is. So what you've got going on is your wife, if she didn't pay into Social Security, Michael, and she's got the government pension offset, which takes 2/3 of her pension benefit off a survivor or a spousal benefit. So presumably she's not going to get anything from Social Security at your death. It's just the way it is. Government pension offset, because she did not pay into the system. Now, my beautiful over here, now she has paid, is paying it now, but let's just say she never did. She would get half of my survival, half of my spousal benefit while I'm alive, and the full extent of my survival benefit when I'm dead, even though she didn't pay in the system. All right, so that's where people get all up in arms. Like, wait a second, that lady over there, or husband, but generally lady, why she didn't pay in the system? Why should she get a benefit? Why should my wife not get into it? Neither paid into the system. The answer to that is we just don't want spouses dying in poverty. That's why FDR, with all his crazy freaking New Deal stuff, but he wanted to make sure widows did not die in poverty. And the way to do that, especially back in the old days, was to make sure that widows received a benefit at the death of the primary breadwinner. And that's not changed. And could that change? I highly suspect it never will. Will it change the GPO? That'd be the way probably to go. The problem that you got, Michael, is that teachers and all these labor unions haven't done themselves a favor with a political party by throwing their weight into one scoop. And the sad thing is, I know tons of teachers who are pretty conservative people. They're not voting for freaking Hillary. I'll tell you that right now. But the teachers union is so far to the left, they're not going to get just a lot of sympathy for supporting repeal of the GPO because they've gone so far to the left that the other side of the political party says, why would I grant you any exception, teachers union? NEA, I'm talking to you, the NEA and the AFT. Why should I do anything for you when all you've done is backstab me left and right? We're not going to do that. And the thing that ticks me off, just like freaking labor unions, Teamsters, many of these guys are hardworking, righteous Americans. It's their union leadership that's gone down the roads and led these unions to take one political side and not try to play both ways. It's stupid, man. Richard Trumka, perfect example of that. AFL-CIO, that guy has gone full-fledged, full throttle with the left. Illegal immigration, gun control, the whole thing. That has nothing to do with labor union issues. And same with the teachers union. So with the GPO, I know tons of teachers, tons of union guys. A lot of them are righteous, freaking hardworking Americans, more so than a lot of these freaking crooked Republicans on Wall Street. But because they've thrown in, and people like your wife has allowed the teachers unions, because they're the squeaky wheel, to dominate the political leanings of their union that they belong to, you're not going to get a lot of sympathy for average Americans when it comes to getting rid of the GPO. It's just not going to happen. And the reason for that is because most Americans don't have a pension now at all. So they're going to say, wait a second, you're griping about your pension? Well, we don't even have a pension. And that's what you got to deal with. And if I were part of a union, a labor union, I would start my own, just like the AARP. There's a alternative to that. I forgot what it's called, because you can't have these guys going full throttle to the left. You can't. You have to play both political things. And the NRA is a perfect example of that. Believe it or not, there are a lot of Democrats who support the NRA. They do, I'm telling you right now, right here in Georgia, they support some Democrats who I'm very familiar with, who definitely aren't right-wing, that's for sure, over more right-wing pro-gun guys on the Republican side. But they did so because they need to be bipartisan. And that's smart politics, without question. Anyway, that's why. That's their answer right there. Sergio in the house. Rich, once you get a handle on the spending, then you really understand how much you need and how much you have saved to compare and understand the gap. Yeah, no, it's all about the spending. It all comes for the spending first and foremost. Once you get a gauge what it's going to be. But I'd make sure, Rich, is a realistic gauge, not just some fanciful, 70% of your last year retirement. It's freaking stupid. What I would do is I actually cleaned up the other day, so I don't have all my utility bills. But I'd look at my utility bills. How much kilowatt hours am I spending? All right, well, I got a house of 6 here. Am I going to spend – what do we spend? What do we use here? 50 kilowatt hours a day, I think is what we use here. We use 50. I have LED lights all over the place. I use 50 kilowatt hours a day because the house is 6. And look, we're pretty frugal, but we're not living like paupers. Let's just put it that way. Am I going to truly spend 50 kilowatt hours a day on my electricity bill when it's just my wife and me and we downsize? No. So it's got to be realistic too. Don't just say extrapolate 50 kilowatt hours a day of electricity consumption and think I'm going to use that in retirement. It's not likely to happen. So you got to get the spending in realistic, but I completely agree. They use fear to try to control us. That's 100. I mean, what do you think the devil is about? That's what the devil does. It makes you fearful. Those people, look at those people over there. You should be afraid of them. In fact, not only should be afraid of them, you should hate them. That's what the devil does, man. And C.S. Lewis says it best. We can have overly fearful of the devil, or we can not mock him, overly fearful, or just think he's a clown in tights. That's what C.S. Lewis talks about. You don't want to be too scared of the guy, and you don't want to just think he's just a clown in tights, that he doesn't have any power. You want to recognize him for what he is. He's a scoundrel that will lie to you at all costs. He will try his best to make you scared, which allows him to put hatred in your mind, and hatred will lead you to him and away from God. That's what fear does. It makes you hate, and hate is not, I don't think that's what Jesus was about. All right. So, Ross, there's another window where several of us have been waiting for you to come online. Yeah, I don't know how to open that window, man. I tried that. I'm not sure, Ross. So I'm not sure how to do it. I used to be able to do it. Just click on this and you could do it. And for some reason, I can't. The YouTube beta has changed their thing here now, where you got to click on this and there's no link. Just click on it, go started. So I'm not sure why that's the case. I don't get it. It's weird. I messed around with it 5 minutes before I got on here. I couldn't figure it out. It's actually nuts. If those percent are gross salary, it's really crazy. Yeah, no, that's right, JD. So that's gross salary before 401ks, FICA, and all that stuff's nuts. My man Bruce says they take the highest three, don't have to be in a row. There you go. Okay, so that's and Bruce is a Leo, so he knows they take the highest three. So you're gonna. I mean, look, man, you can gripe all you want. The facts are, if I'm an employee and my pension is based on my highest three, you freaking doggone, rest assured, I'm going to bust my butt to get on the highest three so I can get the highest pension. I mean, I didn't make the rules, but I'd be foolish not to play by the rules that have been established before me. Oh, but someone's got to break the chain. Yeah, well, that someone's not going to be me. I mean, I get Oregon. Jeff's in Oregon. What's going on, Jeff? Oregon, beautiful Oregon. The magic sauce you provided is hope. Your examples are realistic and achievable. They are believable by the middle third, and the bottom third can see maybe I can do it too. Yeah, that's what I'm hoping, Jay Snyder. 303. Is that 303? Is that Colorado? Is that the 303 area code? My hope is that just because you're on the poor side doesn't mean you got to freaking eat ramen noodles all day long. And that's why my book, which once I finish this guy up, one more chapter on what you can retire from Social Security, I hope will provide hope for those guys as well. Cochran, Georgia. Boomer benefits sounds great. Do I have any followers that use them? Yeah, I don't know. I've had a number of people, probably 5 reach out to me, said they're going to, and they like Danielle over there, but I don't know if anyone's actually followed up and done it specifically, Rick. But I'm a fan of Danielle. But don't forget, I'm a fan of my man J.O. up there in Michigan too. I mean, Jay, two completely different personalities. Jay is a son of a medical doctor, very structured in terms of the way he talks, very focused, very diligent in his planning. And not a lot of fluff. I'm not saying Danielle's not like that. I'm not saying that like at all. But some people like the direct approach and say, just give me the numbers. And Jay's like that. He's used to be an arbitrage trader before he became a health insurance specialist. So J-O and Jaeoh. That's what it is. J-O, Korean by ethnicity. Born and raised in America, but I forgot the name of his firm. But anyways, J.O. He wrote the book, literally wrote the book, Maximize Your Medicare. The new edition's out, which I think I have a little, when you write the thing, the beginning of it, whatever it's called, the prologue or something like that. Will I ever do a video about federal law enforcement officers who can retire early at 1.7%? I don't know what that 1.7% is. Is that 1.7 for each year you work, Sam? So if you work 20 years, you times that by 1.7, and your pension is 20 times 1.7 is 34% of your last three. That's the only thing I could think what that would be. I'm not sure what the 1.7% is. Have I created a video on monthly dividend REITs? I did a video the other day on how you can earn, I think it's $2,600 a month on monthly income accounts. REITs are a predominant amount of that, but not specifically in monthly dividend REITs. Actually, it's pretty funny too. I was reading an article just the other day about, it was a REIT out of Canada that's trying to buy up all this land in Atlanta and other places like Phoenix, and they had paid 12% a year for a while, and now they're going kaput, if memory serves right. And it began with a W, the name of the company. Oh, man. And I said that's a perfect example of illiquid, non-publicly traded REITs. There's almost, I'm not going to say it's a Ponzi scheme. I'm not saying that, but they're getting the money to pay the 12% dividend yield from someplace. And I forgot the whole back. I was going to do an article, video on it. I forgot. But anyway, long story short, so now they're trying to get more funding, and people are like, not so sure, because the last batch of investors they're not getting their 12%. And I just non-publicly traded REITs, I think you should stay away from them. That's all there is to it. Now, my man isn't asking about non-publicly traded REITs, but when I hear REITs generally speaking, and I see that term REITs, REIT, real estate investment trusts, the first thing that jumps out at me is non-publicly traded because they have a higher yield. And everyone just focuses on the yield without understanding the underlying business underneath it. And I was reading in my study from the, I don't have it here anymore. I just threw everything away. All the stuff I used to refer back to. And the Financial Planning Association, their survey of financial planners, a significant amount of these guys offer non-traded REITs to their investors, to their clients. And I don't know how you can call yourself a fiduciary offering non-publicly traded REITs. I literally don't know how you can do that. And I friggin' nuts. Don't buy it. My man Z-Man, do I trust a personal cap app? I haven't used it in a long time, my man. I don't know. Initially, the personal capital I liked because it was it gave me $25 and you $25 every person who signed in and opened an account with them. Not open an account, but I think linked an account, which seemed pretty attractive to me. But then my man Corey, who was told me about it, he got off it, and I haven't gone on back since. And the reason wasn't just because Corey, but they don't do a whole lot in terms of tax planning, which I like the tax planning stuff. I thought they're pretty good, man, on retirement planning. I was pretty impressed with them on retirement planning, but for me, the tax planning stuff is what gets me fired up. So if it's not tax planning heavy, frankly, I don't have the time to look at it. So I'm not saying I don't trust it or anything. I just haven't really looked at it for about going on probably 8 months now. Jeff, are REITs and MLPs, master limited partnerships, dividends taxed the same as qualified dividends from stock like AT&T? I don't believe they are. So I know preferred stocks are as qualified dividends. On REITs, I don't think that's true, Jeff. But I used to have a guy, Ken, the Atlanta tax guy. He's not on that I see very often. He would always answer some of these questions. I don't know the answer. My inclination is REITs are not taxed as qualified dividends, and MLPs are not either. But I don't know that for sure. So I'm open to being incorrect. If anyone knows the answer, put it in the notes, please. What is your fee? What do you provide for it? I'm changing that as we speak here. I was actually just talking to my wife, and I wasn't going to bring this up today, but so basically what I'm going to do going forward, it's very important to me, Tina, to be able to retain a client base that can afford me, if that makes sense. But it's also very important to make sure that people are paying for my time, if that makes sense. And it's one of those things that over time, I have a tendency to be a little bit more lenient on my price than I should be, just because I come from a background where I don't want to get into it. But anyway, so what I'm going to do going forward is that if you got a liquid net worth of over $1 million, we're going to charge, as I've been this whole time, $2,500 for a full-fledged financial plan. If you have a liquid net worth of under $1 million, we're going to charge $950. And I'll put that on my website probably tomorrow. Yeah, I literally I've been thinking about this all day. I had a couple guys reach out to me, and what's the word? I wouldn't say I was ticked off, but it's kind of like, man, that's not what the point was. So I was charging $250 an hour, and this one guy was a medical doctor, and he said, I'll just pay the $250 an hour instead of doing the full-fledged financial plan. I'm like, dude, I mean, I don't know. The point wasn't to underscore myself, is to allow people who might not have been able to otherwise afford me to get a chance to talk to me. And I said, that's not, and I had 2 or 3 guys, and along the same lines, it's like, you got a couple $1 million. It's weird. I was offended by it. I'm not going to lie. And look, I got thin skin in that regard, but it's like, that's not what the point was. The point was that so a medical doctor with a couple $1 million could, kind of shortchange the system. That's not what I wanted to be. And so I said no. And so I said, I can't do that. And I got too caught up in explaining the whole thing about charging $250 an hour. Is I really just wanted to talk to people if they had basic investment questions to answer them for them. I had a lady email me today, what do I think about this mutual fund? And that's pretty simple. And I can do that without even charging a fee for that. I got no problem with that. But that, I don't want to, I don't know. It's just, I didn't like that. And I've had kind of a bad taste in my mouth because I've had that more often than I'd like to admit, where people say, why should I pay you $2,500 so I can do the 250? And I'm like, because you have the financial wherewithal to do it. That's why. And you don't have to pay. I don't care. I don't have a gun to your head. But anyway, so, and what I'm doing is I'm going to do a full plan. I mean, we're going to do a plan for everybody going forward. So if someone wants to hire me and their liquid net worth is their 401k, IRAs, the whole thing, like cash value, life insurance, bank accounts. If it's over $1 million, I'm going to charge my continued $2,500. If it's under $1 million, I'm going to charge $950. And obviously I reserve the right to change that anytime. The reason for that is because generally speaking, over $1 million is when the real tax planning needs to be done, without question. Under $1 million, it can still be done. But generally speaking, if you have under $1 million, I had a guy reach out to me just today. He's 39 years old. He's starting to do pretty well for himself, but he's not anywhere near having $1 million. And the planning for a guy like that is not nearly as in-depth, intense as the planning for a guy or a lady who's 62 years old, got $3 million, and they're like, man, we don't know when to take Social Security. We don't have estate planning up. There's a whole different planning scenario for someone 39 years old who doesn't have the same kind of assets or planning needs as someone who's 62 years old and is looking at pension options, all that. And so that's what I'm going to do. So I hope this makes sense, but it's really based on liquid net worth because I still want to make it worth someone's while for me, and from an investment perspective, where they can hire me for a fee that's right for both sides of the equation. And I still want to be there for someone who's got $350,000. I do want to be there for them, but it's not going to be cheap. I mean, it's going to be an investment into the scenario, and that's the only way we can do it. And so anyway, I appreciate you asking, but it's interesting you said that. That's what I charge. I don't offer any refunds. I had a lady, actually that kind of did tip me off too. And that's back when I first started out, and she asked for a discount. I gave her a discount because she was just a single mom, and she worked in an airline or something like that, just as a airline attendant, whatever. And I felt bad for her. I gave her a discount, and then nothing. She was doing great. And I said, look, your whatever name is, Amy, you're doing great. Nothing needed to do differently. And I never quit. She sent me a snarky email about, do you really think it's fair to charge her $500 to tell her she's doing great? I said, yes, it is fair because it's my time. And I said, I don't like that at all. I said, because you're paying for my time. So just going forward, to anyone who's interested, I'd offer no refunds. Do not hire me if you think there's a refund. I'd offer no assurance that you'll like what you get. I offer no, I have no idea if it'll be worth make your time valuable in terms of will we be able to save you $2,500 on taxes? I don't know. I have no idea. And that's up to you. You're gonna have to, maybe consult with the big guy upstairs and say, do you want to invest $950 or $2,500? But just be advised, if you do, there's no chance of refund. I cannot refund my time. And so because of that, I mandate that you pay me up front. We'll get you the planning software, which you have access to unencumbered for as long as I hire Right Capital. And I love Right Capital software. I get this question a lot. When do I think I'll change? I don't know. I mean, there's a couple of things I wish they would change on the software, but 98% of it is flipping fantastic. 2%, I wish if they could just change that a little bit, be even better. But I don't think I'll ever get rid of Right Capital the way they're going, because they're the only tax planning of its caliber. Nothing else comes close. Not eMoney, which Fidelity now owns, doesn't come anywhere near. And eMoney was the gold standard. Doesn't come close. So anyway, Rick says, how do we get an appointment with me? Just send an email, Vicky. Well, you might not now after you just heard my diatribe on how I charge. It's all good, man. That's the thing. When the big guy takes care of it, it all comes back in droves. I'm not all that worried about it in the least. There'll be enough people who want to hire me, and I'm completely comfortable. It's very liberating to have a relationship with a big guy, by the way. I don't know if I ever told you that. When you do have a relationship with the Lord, whoever your Lord is, mine is Jesus. When you have a relationship with Jesus, you just it goes back to that short story. Lazarus laughed because Lazarus, when he came back from the dead, he just looked around. He said, all these people are up in arms about stupid stuff. I've been on the other side. None of this matters. It's as liberating as I can be. Lazarus laughed is a wonderful short story to read. How do I feel about Vanguard personal advisory services? So I did an article, video on this not too long ago, Rick. So I had a guy, a great guy out in Texas, husband, wife, wonderful, wonderful people, reach out to old Vanguard. The drawback is boilerplate. There's no other way around that. Is boilerplate. Let's just call this guy, I don't know, we're going to call him Matt. We'll call him Matt from Texas. And if he's online, he knows who I'm talking about. The drawback was Vanguard, they don't allow you much maneuvering around their boilerplate stuff. So let me give you an example. I love the barbell approach. 3 to 5 year CDs, the rest in stocks. Done and done, you're good to go. Vanguard doesn't believe in that. They believe it should be, and they believe the 3 to 5 years in CDs should be in bonds because you're potentially missing out on upside. And frankly, I find that to be silly because there's no evidence of that in this environment at all. None whatsoever. If anything, there's significantly more risk for no more return on bonds. But I get what they're saying. At the end of the day, bonds historically have done better than stocks than CDs. Thus, we want you to be in bonds rather than CDs. But the problem is you're paying the fee for that side of the equation too. And at least with the CD, the barbell approach, there's no fees. You have no risk, no fees. You're getting the same returns as bonds. And you have access to it in the barbell scenario. Every year a CD comes due, and you take that cash, and that's your spending money. Vanguard didn't see that. Now, look, this guy initially, Monty and Pam, we'll call her Pam, the guy was a little bit, not off-putting, just a little bit, what's the word I'm looking for? Not as personable. But he said as they got to know him, he got a little bit better. He had a dry sense of humor and whatnot. So I was glad to hear that. He actually had a personality. So I was very pleased to hear that. So what Matt and what Matt and Pam and I suggested to them is just give Vanguard, let's say they had $1 million, give Vanguard the $800,000 and put the $200,000 in CDs, if that makes sense. And I thought that was that's pretty fair. And I don't know if Vanguard, I don't know what, they haven't got back to me if that's, Vanguard's cool with that. It doesn't matter. Secondly, I had another client in Florida, and these guys weren't overly wealthy. They needed to protect their bottom line. So we did the whole thing with the barbell. This is back almost a year ago now. And Vanguard was very hard for them to move their Roth IRA to 100% stocks, because they were moderately aggressive. So moderately aggressive for Vanguard meant, 65-35 across portfolios. And I said, no, we don't want that. We want your Roth to be 100%. We want your taxable accounts to be 100% stocks. We want your IRAs to be 100% bonds. Vanguard didn't see it like that, even though they've written tons of stuff on asset location. I was dismayed by the lack of, of the left hand talking to the right. I said, dude, you write all these articles in asset location. We're putting asset location work for these people. Again, taxable accounts, all stocks, Roth IRAs, all stocks, deferred accounts, all bonds. And Vanguard, it's like pulling teeth to get them to capitulate. And even then they didn't. It's nuts. So it's boilerplate stuff, but by and large, I'm a fan of them. I really am. I got no qualm with them at all. They aren't going to do extraordinary financial planning. I'm just telling you, they won't. In fact, it's interesting on their PAS, their brochure, they got rid of, at least that I could see. Last year, I did a video on it, and they said they do comprehensive financial planning. And I know for a fact they don't, because I know people who work there. And they said, no, we just run our own internal Monte Carlo analysis, and that's it. That's not comprehensive financial planning. And so so now I don't see that on their personal brochure. And I don't know if that's because of pushback or hopefully maybe someone like me. I don't know. But they didn't say that anymore, comprehensive wealth management / financial planning. So that's a step in the right direction, because they aren't doing that. And they're not going to do any tax planning. They're not going to give you full throttle significant tax planning either. But for the fee you're paying, I'm a fan of it, man. And if you just need someone to manage your money, rebalance on a regular basis, where you can talk to a couple times a year for 35 basis points, I got no qualm at all. My man Robert says, I'm thinking about early retirement. I'll quit at 55. Have access to a 401k. Should I tap my 401k early or spend down cash? Tap into your 401k early, 100% right. It's not going to be subject to penalty. because you're post 54 years old. Presumably, the access to your 401k is still the company that you're working for, that you're going to separate from. Absolutely, leave that cash alone, man. Question: go ahead and pay the tax now, because when Social Security kicks in, it'll be taxed even more because of Social Security tax torpedo. Yeah, Tom Major, Gibson versus Oberlin College. So glad. Yeah, 44 million. I do know what you're talking about, Tom. I tell you, I think that's for y'all who haven't paid attention. Now, we don't know if it's going to be full 44 million, because in law in Ohio, it's only 2 times of punitive damages or something like that. Oberlin College, and they have literally the people. This is where Lena Dunham went to school and falsely accused some guy of raping her. And she was so. We were able to identify, not we, but anyone was able to identify who the hell she was talking about. It's some dude. I mean, literally, she accused this guy of raping her. It's all fake, and nothing happened to Lena. Anyway, wrong answer, man. You ever heard of a conservative is a liberal who's been mugged? A libertarian is a conservative who's been falsely accused. That's my corollary to that. And having gone through that myself, not with false accusations of rape or anything, but falsely accused, I'm very sympathetic to some of these black folks out there who get falsely accused for peddling and stuff like that, when in fact they're just in the wrong place at the wrong time. Just let's keep that as it is. Falsely accused, being arrested is not the same as being guilty. So don't just say, oh, he's arrested or he's accused. That doesn't mean crap to me. I don't care. Anyway, so in this case, Gibson, the Oberlin College, freaking just social justice warriors through the school, advocated going after Gibson Bakery, who's been there since 1890s, because they're racist, because they said that some black kid stole some wine from him, and that kid actually admitted his guilt. Crazy. And they had these flyers to protest, to basically just, it was like freaking a pogrom. It was nuts. And these people are protesting, freaking nuts. And they got spanked down. That was one of the best things I've seen happen in a long time. It made me so happy, because what these schools don't realize, normal people from the left, the right, and the above, which is what I would consider myself, a libertarian-minded person, they don't like this stuff. What's going on college campuses today? That's repression and oppression like we haven't seen. They're living in repressive states surrounded by utmost freedom the world has ever seen. And yet the schools are having is nuts. And I could not be happier. And the funny thing was, I don't know if you saw this, Tom, but the insurer said, we're not paying for that. That wasn't part of our contract. So they got almost $1 billion endowment, and they pleaded poverty. Like, we can't pay this. It's going to hurt the students. The same students who protest these guys at the bequest of the freaking administration. So phooey on them. I could not believe, man, it's makes me happy. All right, so let's see. All right. Ooh. All right. Thanks for being on board here, guys. Let's see here. Hey, Gary. There's Gary. All right. Wow. All right. Hold on just a second. Trying to catch up here. Okay, there we go. Most public sector pensions figure the pension based on the average of the highest 3 years rate of pay, not their actual earnings. I don't know if that's true. Most on the average of the highest rate of pay. I don't know that to be true, man. I've heard it many different ways. Then Tom responds, can I take it with me when I die? If not, I am not going. JP Morgan reports top asset class for the last 20 years. REITs, gold, oil, S&P 500. No, that's why I need my man 712 portfolio from Craig Israelson, right? Diversification. Robert, should I spend now 401k and non-retirement account to stay in lower tax bracket and avoid RMD tax increase, and then only tap? Oh, yeah. No, leave your Roth. Don't touch a Roth. Leave that be. Absolutely. Jerry or Gary, I always don't know how to pronounce it. We're going to say Jerry or Gary. My retiring parents and us talked about buying a home for all of us to live down in Texas. What do you think of multi-generational households? I would not put your name on the deed just because of lack of a step up in basis at the death of your parents, Jerry, what did I say I was going to call you? probate's not that big of a deal. It's just not that big of a deal. I mean, look, each state, each county is different. I get that. But if you're buying a place in Texas and you are on the deed at Texas is a community property. At the end of the day, the lack of a step-up basis is what would concern me. I.e., I buy a house with my mom. The house appreciates from $400,000 to $1 million. And so we bought it for $400,000. My cost basis is $200,000. Her cost basis is $200,000. It appreciated to $1 million. So basically, I have a $500,000. That's my asset. Her asset's $500,000. I get a step up in basis on her date of death value, but I do not get a step up in basis on the $300,000 that appreciated for me. It's confusing to say over this. I get it. But essentially, I'm losing out on a step up in basis on $300,000 in that scenario. Yeah, that's not good, especially when I can just leave it in her name and just go probate it. And you can even put it in a living trust if you want. If you put it in a living trust, there is no probate, and you still get a step up basis. How it works in a community property state, you'd have to see legal on that. But with community property on spouses is very, very favorable, much more so than joint tenants or rights of survivorship. I don't know how it works on non-spouse, community property between mom and son. I don't know. But there's a lot going on there. But at the end of the day, I don't like it having different names on the deeds just because you violate the potential for step-up basis. Sperm Donors Day. Is there a positive direction on metals? I have no idea, man. Don't follow it. I mean, I have own gold, but I don't follow it on any given day. Josh, we're 21 minutes in there and still 4 people waiting for my man. I'm sorry about that, Ross. Josh is retired 59, now going on Cobra for the next 18 months, but then old job has retirement insurance. They're both pricey. Besides the government site, what other options do I have? Just retired 59, not going Cobra for the next, but then old job has there. Yeah. Then old job. I mean, you got MediShare if you're a faith-based person, MediShare, Liberty. You can go without insurance. We'll see what you can do. Short-term plans, 364 days. You can go work part-time at Starbucks, part-time, I think Lowe's, as long as you work there 30 hours a week, you get health insurance, drive a school bus. I mean, there's lots of different things you could do. You could go get a job for 3 months and then say, I'm out of here and take the Cobra with you. Lots of different things you can do. And I would hope by then we shall see, but this is a big deal. And I don't know. I'm not relying on the government to fix this stuff, but at the end of the day, your frustration, my frustration, there's huge frustration for this because of Obamacare. There's no other way around that. Obamacare really put us to the wall. Now, does it offer some benefits to some people? Absolutely. Absolutely it does. Does it put us against the wall for what we used to have and be able to buy and afford? Yeah, absolutely there too. There's no denying that. So hopefully there'll be some fixes, but don't hold your breath. And let me go back to Ross. Ross said there's a couple people waiting. There are 20 minutes waiting for me. And the other thing, I don't mean to make light of that. I don't know how YouTube wants me to click on the link for that anymore. It used to be YouTube, just click on the link and you're starting off right from that link right there. So if you've been waiting there and are ticked off at your old buddy Josh, my apologies. I just don't know how to do it. I mean, I'm telling you right now, it used to be click here to go live, click done. And that was the link. And so I'm going to have to figure that out because that's, they got rid of that when they changed their methodology on what's called a YouTube Studio Beta, which is frustrating. Vanguard Advisor, and I don't know how to go there to tell people to come here. I'm not sure how to do that. Let's see. Vanguard Advisor, spending non-retirement account down to allow for tax deferral growth. It's the higher tax bracket. Yeah, no, I agree. Higher tax bracket RMDs without question. No age limit for a Roth conversion. No. In fact, I had a guy email me earlier today. Forgot his name. And he was starting off. Man, I think he's been in financial planning for a long time. This kind of concerned me some. His question was, how do you do a Roth conversion without income limits? I'm like, oh, goodness, man, without having a Roth IRA open because they have no earned income. I'm like, dude, if you're a financial planner, you should know this. I hate to say it, but if you don't, you need to read up on Roth. The mechanics of it's simple. You just call Vanguard, say, hey, I'm doing a Roth conversion. They say, what do you want me to do? And they'll walk you through opening an account in which to put the money in. Financial advisors need to know that. That's all there is to it. So I have $100,000 in a traditional IRA, and I have no more earned income, or I make too much money. It doesn't matter. It literally matters not. I could be 1,000,000 years old. It matters not. I get $100,000 in a traditional IRA. I make $1 million a year. I make nothing. I'm 1,000,000 years old. It doesn't matter. I say, Vanguard, I want to convert 50,000 to a Roth. They said, okay. Do you have a Roth you want to put it into? No, let's go ahead and move one over now. Vanguard takes care of it. Done. So what happens is you have a traditional IRA account, A, B, C, D, and now you have a Roth IRA account, whatever, E, F, G, Y, or whatever it is. And that's it. It's if you've been in the business a while, don't know that. We got some work to do. That's for sure. How will you as a consumer know about this, about a guy you're looking to hire? I just, man, I don't know. I don't know how because it's not just a CFP. The CFP is a good starting point. I could care two craps about the fiduciary thing. I don't care about that. In this case, a guy worked like a school district 403B plan. So I don't want to say too much more than that. But generally speaking, from the firm he came from, I just had a sneaky suspicion that he'd been focused on selling products and not financial advisory. And if he's on this podcast or whatever this is, I'm sorry, man, but you got to know this stuff if you're going to be a professional financial planner. This is pretty elementary stuff here. How do you make it happen? Especially been in the business for a while. Look, I take the business seriously. I do. The business has done wonders for many, many people, but it's hurt many, many people too. And the thing that makes me mad is I got to fight two battles here. One is that the industry is so freaking desperate to make it where the barriers of entry are so hard that we're basically being like, you might not remember this, folks, but in Arkansas, if you wanted to build coffins, wooden coffins, and sell them in the state of Arkansas, it was illegal for you to do that because there's one company granted rights to do that in the state of Arkansas back in the 90s. One company. That one company had to grant you permission for you to compete with them. What's the likelihood you think that company is going to grant you that permission? All right, so that's what's happening with the CFP, the financial planner credentials. We're trying to make the barriers to entry so vast that very, very few people can come in the business. And the irony of it all is that we want to be more diverse, more minorities and women. I'm like, you want to be more diverse? Well, hell, you don't freaking make it more and more. You have to have a master's degree and 5 years experience. How about that freaking single mom who's raising 2 kids in Anacostia who took financial planning that night? She can't become a financial planner even though you want to be more diverse. Screw that. So we got this group of people who wants, because they want to shut the door behind them so that they can get monopoly powers. I get how that works. Every industry tries to monopolize it. But then you got the other group that says, I'm a financial planner, and they don't know their butts from a hole in the ground. And I'm just like, I don't know how you weigh the two if you're looking to hire a financial advisor. I don't know. And this is what makes a company like Vanguard so beneficial, in my opinion, because at least at the end of the day, we know that they have people who know what the hell they're talking about. I cut my teeth at Vanguard. I'm telling you right now, that's 20 years ago. No, 22 years ago now. But they trained me a hell of a lot more than I ever learned at Smith Barney. I'll tell you that right now. The only thing I learned at Smith Barney was what I told myself. The irony of it all, to use that word again, is when I got my CFP, which I paid for, I studied, they didn't do that for me. I did all my own. When I left Smith Barney, they said I had to pay the money back for my CFP. I said, you're crazy. I paid for all that. They said, they sent me like a nasty letter from legal saying, oh, no, we trained. I said, the hell you did? I thought I was going to have to hire an attorney just to say, you didn't pay for my CFP, fools. So anyway, the issue that we have to contend with is yet a lot of people don't know what the hell they're doing. And then you got a lot of holier than now says, we're fiduciaries. And it's not good. And yet the industry can be so good. So I've met so many good people who are trying so hard to do right by the clients. And it's a fight. And we need the good guys to make sure the uneducated, the ignorant, get that level of education up so they're not hurting people. But then we also need to open up the profession so that more people can come in who have experience as being financial planners. Stay-at-home moms. You think, well, the dad's out in freaking war in Afghanistan. The moms, I tell you, I can't tell you when I worked at USAA how many moms I dealt with whose freaking husbands were, colonels running infantry battalions and brigades and whatnot, and they did all the financial stuff, but they can't be financial planners. Again, food to that. Anyway, all right. So what's the difference between a 401k and a 401? I don't know. I'm not. I've heard of a 401a on occasion, Jeff. I'd have to research it off the top of my head. I don't know. If I buy an index fund, selling some of my fund. If I buy an index fund, selling some of my fund on same retirement account, I have no idea what you're asking me there. If I buy an index fund, selling some of my fund, you call it exchange? I don't know. Tina says, I want to buy a new car and get a new house before I stop working. I just need some advice on how to proceed. You got to run some cash flow analysis. That's for sure, Tina. I don't know. I'm not sure what to tell you here. Not sure why they would say that. If you have a large chunk of money in your 401k, you don't want to have to deal with RMDs. Yeah, I agree with that, Tom. And that's going to Robert. Jeremiah says, are there any limits to the number of stocks or fractions you can buy in a day? I received a over trade warning Friday. I don't know. It must be if it's it depends on your firm, I guess, whatever your brokerage firm is. Thanks for all your advice. Right on, Kyle. Hope so too, man. Would you recommend buying the dip in semis with all the trade war fears, like semiconductors? Man, I don't know. I'm sorry, but this is not a stock show, man. I just, if you're buying the dip in semis, could there not be more dips? This is financial planning. Stop. I hate this. Look, this is going to sound rude, but I have no desire at all to talk about buying dips and stuff like that. It doesn't make any sense to me whatsoever. The only dips I'd want to take advantage of is potentially doing Roth conversions. Look, you can do it. I don't care. I have no experience and certainly no ability to say you should buy the dips, because just because they're dipped today doesn't mean they won't be in the future. All right. The day traders, I can't take it. Am I insane if I can hang in there working their crappy job for about 7 years, 4 months, I'll have access to railroad retirement at $37.55 a month? So the question, Robert, is that if you can stay working there for another 7 years and 4 months, you'll have $37.55 a month in retirement. What could you do in the next 7 years and 4 months that can replace that? That makes sense? Maybe it'd be something you enjoy that can easily replace that pension over the next, 7 years and 4 months. Obviously, don't quit today, but maybe over the next 18 months, say, something, I'm really into minor league baseball cards. I'm going to create a website, talk about nothing but minor league baseball cards. I'm going to do a YouTube channel, nothing about minor league baseball cards. I'm going to do minor league baseball card shows when I can. I don't know. I'm just using that for an example. After 18 months, I bet you start seeing some revenue from that puppy. And I'm just wondering if that revenue will start growing exponentially, where that $37.55 a month pension begins to look less and less interesting to you because you're making more and more from your baseball card endeavor, which you actually enjoy. Just something to think about. If you don't have transaction, okay, any comment on L bonds? I don't even know what those are. Get a lot of interesting investment questions here. I don't know. Quit at 55 and collect railroad retirement at 62. Then it's 22.90. Quit at 55 and wait. It's got a decision there, man. Right? So it's a 60% increase. Hey, Gary, we're heading off. So my man Gary quit. He is beautiful, and they were. I remember talking to Gary and his better half, and she had put a hard career in, and it was wearing her down. Gary has texted me many pictures of wonderful places they've gone to visit without the fear of, or not the fear, what's the word? With knowing full well that they can do it, rest assured they're not going to run out of money. And I have a sneaky suspicion her health has probably improved exponentially. It's interesting because her crappy old job, just go back to you, Robert, her crappy old job was grinding her down. Gary said it. And for him too, but he quit his crappy old job, and he was waiting for her for about 6 more months before she could quit her crappy old job because she was getting ground down. And now they're enjoying it. So Gary, tell us where you're going, brother. My man, other Gary, if I turn 55 in August 2020, I can quit my job then on January of that year. and tap into that from my employer free. Hey, right on, dude. Happy Father's Day to you too. All right. I turned 59 and a half on February 15th. After quitting, I'll transfer all but 5 years plus 1.5 months of living expenses. Okay. The company I work for is offering a buyout on our pensions. Okay. We have two options: take a lump sum or okay. All right. So there's a good question. So South Carolina road trippers. All right. I don't know how old you are. I'm not sure if you're married or not. The rule of thumb, yeah, my man Sergio, highest commissions for financial advisors on non-traded REITs. Shocking. The rule of thumb on pensions. All right, I'll say this because I love this one. This is a great question, my man. Let's just say you have $100,000 that you could roll to an IRA, or they're going to give you $7,500 a month in income, covering a joint life survivor annuity, JLSA, joint life survivor annuity. If it's a joint life survivor annuity, that means you get 100% most likely. This is what you want, generally speaking, 100% to you, and then when you kick the bucket there, 100% to your surviving spouse. So we're going to say you have a joint in life survivor annuity. If it's just on your life, you're going to get $7,500 a month. If it's a joint in life survivor annuity, it's going to be $7,000 a month. Does that make sense? So $7,500 a month only covers you, and your death is gone. Or $7,000 a month, it covers you, or a year, year, not month, year. $7,000 a year, it covers you and your surviving spouse. As long as one of y'all are breathing, someone's getting $7,000 a year. That makes sense? So you got $100,000 is the amount you could roll over, or instead you could turn that sucker on and get $7,000 a year for your joint and life survivor annuity. So that's a 7% distribution payout. Notice I didn't say yield because it's not a yield. It's a distribution payout. A portion is return of principal, and a portion is interest. It's all going to be taxable to you as income, but still a portion is your return of principal and a portion is interest. If you can get 7% as a distribution yield, I would take the pension, freaking 95 times out of 100. If I'm getting below 6%, I'm probably going to roll that sucker over to an IRA. All right. The sweet spot is 7% or higher. The unsweet spot is less than 6%. The depends is 6 to 7%. I hope that makes sense. So remember, it's simple. How much of an annuity am I getting? I'm getting $7,000 a year. Divide that into your lump sum amount, $100,000. That is a 7% distribution yield. I'm taking that pension. Conversely, I'm only getting $5,000 a year as an annuity. I have $100,000 lump sum. I'm dividing 5,000 into 100,000. That's a 5% distribution yield. I'm going to roll that over to an IRA. Hope that makes sense. If it's a $6,000 a year, that's 6%, and I would probably take the pension there. I'm more conservative than some of my peers, but if it's 6%, generally speaking, and it's a joint and life survivor annuity, I'm probably taking the pension there as well. Hope that helps, man. Good question. So Tina said, okay, thanks. I think it's fair, especially we can discuss tax planning, Roth conversions, etc. Right on. Gary, this is my understanding of a bit of conversation I saw above. I'm missing that. So Don B, 6 weeks past rotator surgery, 5 more months of PT than Bell. So I'm sorry I emailed you, or I put this on the YouTube channel on response. So good question, though. ETF and a Roth as opposed to mutual fund. Hey, Dan, you're probably late because I couldn't figure out how to click on the other link. And if you are late for that, my apologies, my friend. And all you who are joining me late because you're waiting on the other side, again, my apologies. I don't know how to do that. Anyway, ETF, the drawback with ETFs is quite simple, is that if you're making regular contributions, you actually got to go in there and make the trade. There's no method to have it automatically reinvested, or automatically invested, I should say. There is no. Mutual funds, they do, because mutual funds are an open-ended investment that just take your money, they invest it at 4 p.m. at the day they receive your cash, and you're good to go. You don't have to do anything. $250, $250, $250, it all goes in there just like clockwork. An ETF, you actually got to put the money in there, and then you actually go make the transaction, which could cost $4.99 or whatever. So ETF, if you're adding money to it or taking money out of it regularly, is a pain in the butt, without question. So if you're adding money to it or taking money out, I'd always use a mutual fund. If it's just a one-time thing, got $100,000, you're dumping it into your Roth. In that case, do an ETF. That's the way I see it. Hope that helps, Jeff. I hope Arizona is treating you well, my friend. Jim McMahon on board. Jim McMahon, Roselle. You probably heard that many times in your life. So I had to make that joke. What is safe rate to use for projected investment in stock market? Safe rate to use. So I use 7.5%. A diversified international portfolio, a diversified portfolio of international domestic stocks and everything. I use 7.5%. That's gross before inflation. A diversified portfolio of stocks and bonds. I use 3% for bonds, 7.5% for stocks. We're looking at 5.5, roughly 5.5 to 6% right there. That's what I use. Shoulder, it still hurts a little bit, man. Yeah, Mary, you might have been on the other line too. And if you were, again, I apologize. For you all being late to this, because I just did not know how to click on the thing. I apologize. Shoulder still hurts, but it seems like that the way my lady Whitney was telling me, like, if you can just survive through Saturday, you'll be fine. I thought that meant the pain would go away. No, not at all. It's still there. It's not as bad. Thursday was bad. It's not as bad, that's for sure. And why do you worry about clothes? See how the flowers of the field grow. They do not labor or spin. Yeah, right on, man. Yeah, not a lot of smashing going on, says my man Bruce. Do me a favor, if you like what you see, smash the like button there, because it does help me with the algorithm for sure, our YouTube overlord algorithm. Gary, just don't transfer 401k to IRA before 59.5. Yes, man, Robert, that's a great point, my man. Don't wonderful point. And that is, I actually want to talk about that. If you are separating from service after you're 54 years old, it'd be crazy to transfer your 401k to an IRA. Because you're going to lose, like my man Robert says, the ability to tap into that 401k sans penalty. Sans, get that? Pretty good. French, right? That's French, that's all I know. Parlez-vous that and sans. So it'd be crazy to tap into your 401k or roll your 401k to an IRA until you're over the age of 59.5, because you're going to get the 10% penalty. Don't do that. So right on, Robert. And Gary Edwards, hope you understand that too. It's incredibly important not to do that. Secondly, if you're inheriting an IRA and you're under the age of 59.5, do not roll that to your own IRA. Oh my goodness, I can't tell you how many people make this mistake. Excuse me, man, gotta stop smoking. Carton of Cools. I don't smoke. What was I saying? Oh, all right. So let's just say Charlotte is my beautiful, and I die. All right, so now I die, I leave all my money to Charlotte, and she's under the age of 59.5. She rolls that IRA, my IRA, over to her for a spousal IRA, and it's fine. She can absolutely do that. Don't do that, because she's under the age of 59.5. If she were to tap into that money, she's still paying the 10% penalty. I've got to do a video on this. I think I've done one on that. I'll do that, absolutely. What she wants to do is leave it in an inherited IRA, right? Because it's death. I.e., your old buddy Josh is dead. I'm with the big guy upstairs now. I die. Charlotte does not take ownership of the IRA. She has access to it because I am death. Death is one of the exceptions to the 10% penalty. But death exception is null and void if she rolls that money over to her own. So no matter what, if you are under the age of 59.5 and you are able not to roll that IRA into your own, don't flip and do it. I'm telling you, so many people say, just roll it your own. No. Why give up a free opportunity for money that's not subject to 10% tax? Well, I don't need the money. Well, you might, dude. You might. And once it's in your name, you can't get around it. Hey. Yeah, Rob W. Sorry, man. Again, I'll tell you, but you must have been on that thing. A lot of people showing up late who I think I got to figure that out. My apologies for y'all showing up late. Again, that was my fault. My man Ross told me about that. I just don't know how to fix it. We'll get it. Is it silly to ladder a CD when 1 year pays? No, I don't think it's silly, Vic. I get the premise, like, why bother? I'm not getting more yield for going out the yield curve. It's more of a mental accounting. Look, I got this 1 year CD, I got a 2 year CD, I got a 3 year CD. And I know that 1 year I can kind of, Vic, is just mental accounting, if that makes sense. So my 1 year CD is paying 2, my 2 year CD is paying 2.01, my 3 year CD is paying 2.02. When I just do one big 1 year CD, it just literally just for mental accounting. At the end of the day, are we really going to see huge increases between now and a year for an interest rate rise? I don't think so. I mean, the Fed's talk about cutting, not increasing. So I don't know. I think it's worth the risk to get them laddered 1, 2, 3. Maybe don't go 5. Maybe do, instead of 500,000 CDs, you do 150 for 1, 2, and 3. High yield savings accounts are 2.1 to 2.5% right now. My man Dustin, go that route. No, I don't have a problem with that. You go to your shared savings account over the credit union. I got no problem with that either. Thanks, Josh, for the answer. It's Jerry, by the way. Right on, Jerry. I appreciate it. I've always said that. How the hell pronounce his name? I have a tiny Roth. Now I'm 63. I'd like to convert a 401k to it. Convert a 401k, the Roth 401k implant annual checks before I take Social Security. Can you have multiple Roth accounts? Sure, absolutely, Bob, without question. Yes, I was getting ready to answer. So Vic asked a good question right behind Bob. I knew this was coming up. I was getting ready to answer it. Speaking of rolling 401k into Roth each year, does that 5-year time or timer on restricting withdrawal set for each year that's done? The answer is, as we don't really know, last I heard. All right, so but most prognosticators says each individual conversion from your 401k to your Roth IRA needs its own 5-year rule. Does that make sense? So going back to Bob's case, look, I'll tell you what I thought I was going to do. And I keep doing this because the thing is getting right there in my neck. It's driving me up the wall. All right, so what I thought I was going to do. When I left USAA, I kept the Roth with a couple $1,000 open. I was going to roll not the whole thing over, but every year I was going to roll enough, almost like a CD ladder, to cover me for that year's expenses, because I've had this Roth literally since 1997 when they first came out. I was at Vanguard and I started. So I always want to keep Roth open because it's been 5 years, right? Once it's been 5 years, you have access to your principal without any penalty or without any taxes. You don't have access to your gains because I'm under the age of 59 and a half, but it's been open for 5 years. So I had my access to my principal. All right. Now the issue is the IRS says, yeah, not really. And so my thought process was, let's just say I had 200,000 at USAA, roll 40,000 into my Roth each and every year, tap that 40,000 tax-free, penalty-free, because I'm tapping into my principal. The IRS says, no, you still have to pay a penalty on it. I don't know if there's ever been a specific PLR, private letter ruling on that. But going back to Bob saying he's 63 now, all right? So he's 63. He won't pay tax on, so he takes $50,000 and he rolls it to that tiny little Roth IRA he's had since 1997. That $50,000 is taxable as ordinary income because that's a conversion. It's no different than a distribution from an IRA. Now, if he were to take that money out, let's say it grows to $60,000, he's over the age of 59 and a half, but he hasn't had that one conversion open for 5 years. So that $10,000 of gains would still be subject to taxes. Does that make sense? It's not a qualified Roth distribution because he hasn't had that one conversion open for 5 years. Now he's over 59 and a half, so there's no penalty. All right, there's no penalty on the 10%. Those are gone. Once you hit 59 and a half, it's gone, just like a traditional IRA distribution. Once you're over 59 and a half, there's no more penalty, 10% penalty on any of that. But for him to convert it to a Roth, if that 50,000 were to grow to 60,000, it would not be a tax-free if he took the 60,000 out because that individual conversion hasn't been open for 5 years. Good times. Clear as mud. I hope that makes sense. But great question, gents. Yeah, good question. Right on. Hey, look, Vic, you're the man of the hour. Man of the hour. There you go. Josh, let's see. Oops. Steve says, test. Right on, Steve. When you lean to the camera The padding on your sling looks like you have a ponytail hanging over your shoulder lap. My old hippie days, Ross. I never grew hair long. I always liked my short hair. I will never have a ponytail. People want to have ponytails, more power to them. But I will never do that. But I can see it right there. Like, looks like I got a ponytail. That's funny. I never hear anyone. Oh, wait. Steve, what scenario does the lower earning spouse receive half of the FRA of the higher earning spouse? What scenario? As long as the lower earning spouse's full benefit is less than half the FRA of the higher earning spouse, and she takes that at her full retirement age. That's the scenario. So if the lower earning spouse's benefit is $500, the higher earning spouse's FRA is PIA is $2,000. So the lower earning spouse's PIA, primary insurance amount she gets at her FRA is $500. The higher earning spouse's PIA is $2,000. The lower earning spouse would not get her own. Oh man, someone give me $5. I appreciate that. I hope I can see if there's a question with that. Much obliged. $5 for the super chat. So if you dine to part with some of your hard-earned cash and send to your old buddy Josh, the super chat's the way to go. The lower earning spouse in that case would jump up to the higher earning spouse's her spousal benefit, 1/2 of the PIA of the higher earning spouse when she's at her full retirement age. Hope that makes sense, Steve. The dude. Oh, great live events of the dude. Well, that's why you're the dude, man. Part with your hard-earned cash. Let's see here. All right. Hope that makes sense, Steve. The dude, if you got a question for me, throw it up there, brother. Never hear anyone say this, but this is my plan. If I have enough to retire, I won't worry about 3% inflation rate and just get a money market rate as long as charts show enough for life. Yeah. Depends on the love the ponytail comment. Nah, I'm never getting a ponytail, Gary. Ain't happening. I'm too lazy. I just like comb my hair by finger. Look at that. You've done. Wife shaves it. I comb it. Done. Look at that. Robert, yes, but just as long as the computer chart shows enough for life, junk in, junk out. I'm telling you, man, when I was at USAA, and I tell you, it still ticks me off to this day. We had crappy old software that said an 80-20, or I should say a 20-80 portfolio of 20% stocks, 80% bonds was going to give you a 6.5% rate of return. It was freaking insane. No one was getting a 6.5% rate of return or 20-80. No one. We bring that up to higher. They say, just go along with it. Right, but the plan's wrong. Everyone is 100%. Every single freaking person is 100% success. No, still go with it. How dare you question the freaking the bosses? And the bosses came from TIA Craft, by the way. Let that be your lesson, my friends, just because they're for the greater good. Or we're here to serve the people who served us. Yeah, there's always bosses at these places who are always trying to make a name for themselves. They're always trying to make a name for themselves by getting the most revenue in by hook or by crook. Always bosses. It doesn't matter. It doesn't matter what company it is. There's always going to be some scumbag who's running the show for a little bit, and hopefully he'll get caught before he screws you. That's for sure. Yeah, well, Tom says, sorry to keep jumping in, but I totally not agree with some sort of 3 to 4% withdrawal rule. I'm not sure that's what he says. I hope you have a good life, says Cantoni. Well, thank you. My life has been wonderful. I wouldn't trade a thing for it. All the trials and tribulations, all the idiocy I've done, all the hard drinking I had, the people I've hurt has led me right here, and I will not trade a thing for it. I still feel bad. I still cringe like, oh, how could you have done that? But it allowed me to be here with my beautiful wife, my 4 beautiful children, knowing that someone died on the cross for this guy, not because of how I live, but because of who I am. 3% for, I don't think Robert, Tom, I don't think Robert's saying the 3 to 4% withdrawal rate was what he's referring to. I didn't get that. He might have been, but I didn't get that. All right, looks like we got Enemy Abby. Can you withdraw from your 401k after 59.5 if you're still with your employer? Absolutely. Absolutely you can, Tina, without question. Oh no, I had to change a poopy diaper. Dustin, you are now the man of the internet. Yes, indeed. Was Dustin the Marine? If you're in the Marine Corps, and I think you were, and you're changing a poopy diaper on Father's Day, that is some serious toxic masculinity right there, brother. And we need more of that in this society. Toxic masculinity. Let us all be toxic men. All right, that's okay. It's not toxic. It's what a man is supposed to do. I missed something here. I missed something. What did I miss? Okay. Wishing you a speedy recovery. Thanks, Robert. I understand your shoulder pain. Yeah, you got it, man. Taking Social Care at 69, not waiting to, yeah, absolutely, Hotel Boz. Taking Social Care at 69, not waiting to 70, fine with me. You had just planted a seed. I'm thinking maybe I can start some kind of business. Yeah, man, I tell you, I wish more and more people would do that. We think retirement means no working. And I said, why does it have to be like that? Even if it's just freaking growing. Watch my man, Reyes the entrepreneur, Reyes from California, Reyes. That dude has done a million things. He's starting to grow radishes. He does this machine, a machine where you get Cokes out of, a vending machine. He does vending machine. He does t-shirt stuff. He's doing all this stuff. He does eBay stuff. He does all kinds of different things. It's interesting. The guy's just hustling out there. He's just a guy. He's doing it. And now look, he's got a YouTube channel. I don't know if he's got podcasts, but he's trying different things. Like, why, when you're retired, let's just talk my man Gary. So Gary, he could do a freaking website or YouTube channel just talking about all the different wonderful places he's been since him and his beautiful have been traveling. I mean, I don't know if it's gonna make any money, but after a while it will. I don't know how much. But man, do something you like. It's just, yeah. Now, look, I'm not saying just folks just quit your crappy old job right there. I didn't do that. It took me a long time before I did it. And the impetus was that the commute. I was looking at driving down every single flipping day to Buckhead and that insane Atlanta traffic, sitting in the car an hour, 15 minutes each way. I said, I'm not going to do this. That's too much of a waste of time. So then I said, well, I don't want to go on my own because I don't know if I can make any money. So I'm going to go work for these crappy old registered investment advisors as fiduciaries. And I recognized real quick that being a fiduciary isn't all it's cracked up to be. And I said, well, I'm going to give it a shot. And I'll tell you, I'll never forget this guy. He said, the worst thing that can happen is that Bruce, my man Bruce, such a good guy. The worst thing that can happen is I fail and I go back to some crappy old job. Well, is that the worst thing that ever happened? Because in the interim, I was able to do this. I was able to do what I wanted to do, to try something, and it's not a failure. At least I can say I tried. It didn't work. So watch my man Reyes the entrepreneur. A great guy. I love his video channel. His channel is a wonderful guy. What do you know about Baird as a company? My financial advisor's company is bought out by them. William Baird? Is that right? I don't know anything, Adam. Not sure, brother. Just real quick, a lady emailed me today about a mutual fund, Mayors and Power Growth Fund. And I don't see if she emailed me back. And I asked her, I said, why did you email me that? I didn't say it like that. I said, but I said, what's your No, she did not email me back. I said, she was my thoughts on it. I said, I didn't get it. Like, what was the situation for her to look at in this fund? And my inclination, I bet, was just an article she read. And I said, that's fine. I don't have a problem with that. But be careful on putting your hard-earned money into what some dude is saying on Yahoo Finance or Kiplinger's or something like that, because these guys don't know any better than you. They just don't. They don't. The number one thing to determine to determine success is low fees. Everyone will acknowledge that. Are there some funds with high fees that do better? Yes. Can you pick those funds in advance? No, you just can't. You don't know who the next Peter Lynch is. You just don't know. You don't know who that guy is going to be. Is Peter Lynch and Warren Buffett good because they're lucky or good because they're good? A lot of statisticians will just say the basic simple of a bell curve, someone's got to be out here, and it just happens to be Warren Buffett or Peter Lynch, but you don't know who that is in the beginning. You don't. So the low fees are the number one thing you can do to assume you'll be more successful than the vast majority of funds out there. That's why I just say, look, like the Wellington fund, I talk about it all the time. Vanguard Wellington, the Wellesley fund for you more conservative types. I don't even know if you can get into prime cap anymore. I don't know. But anyway, the capital opportunity fund, I don't know. Vanguard has good active managed funds and they have good index funds. For me, I'm 100% in the value index fund, 100%. I frankly, I hate to say I don't care. I do. I want to make money. But for me, I recognize the reason why value is more important to me, and not because it's down 10 years running relative to growth, even though I do find that attractive, but it's more risky, without question. Why is value more risky? Because the prices are down. Anytime prices are down, there's a reason that they're down. It's just there's more risk inherent, which means the dividends are higher, the price to books are higher, the price to books are lower, the price of sales, the price of earnings, all that stuff. So that doesn't have to be you, though. But at the end of the day, all that really matters is what is the expense of the holdings that you have, and is it diversified? Yes, my man Dustin said if I was back in the Army, would I go 100% into Roth TSB? Yeah, absolutely, without question. Without question. I don't know anything about Baird. I'm 4 years from retirement at 61. What percent? Mark, I just don't think you should have any bonds, man. That doesn't mean I don't think you should have any safe stuff. I like CDs. If I were you, what I'd be doing, all your money that you're now putting into your investments should go to cash. I'd be working like a crazy man building up that cash holding. I'd have 100% stocks, and I'd be putting all my 401k money, what my company puts in, I'd be putting in cash. You want to build up 3 to 4 years of living expenses in cash. I think it's a great freaking portfolio. I got 3 to 4 years of cash, and I would say CDs. Cash, CDs, freaking savings account over the credit union, I don't care. But something that's liquid, safe, and successful, and the rest in stocks. Bonds don't do you any good. I'm going to say this till I'm blue in my face, but bonds, just to reiterate this, and I mean, I know some of you watch the videos and some don't. See that green thing right? That's freaking tough with that. See that green thing right there? 2.093 is a 10-year. That's a 10-year treasury bond, 2.093. You ain't making no money getting 2.093 by locking up your money for 10 years. But bonds, I can buy a mutual fund. It's still the same concept. Mutual funds are still in the same. Everyone else, I get this 100 times out of 100, like, oh, but I don't have to buy an individual bond. You're buying the mutual fund. What are the mutual fund doing? They're buying the individual bonds. You can't escape how bonds work. They issue at $100,000. They mature at $100,000 10 years from now, 20 years from now, 15 years from now, whatever. In the interim, they pay an interest. In this case, the interest is 2.09%. That's all you're getting. And then what happens is inflation is slowly eating away at that 2.093, slowly eating away at the $100,000 that's mature value. You're not making any money in bonds. So stay with the safe route, CDs. Cash. So what I would be doing if I were you, I'd be freaking building a cash account like crazy. That way, when I separate from service right now, we'll just say I got $150,000. Right? That's I don't know. Say you're spending $50,000 a year to live on. You got $150,000 in cash. Man, you're in a good place. Good place. Yeah, man. My man Bruce says, smash, smash. Debbie, if a couple decided today to execute a traditional to Roth conversion of 100K. They performed the conversion in October. Should they pay the estimated taxes throughout the year to prevent paying a penalty? I don't know why you'd have to do that because you just pay the taxes. I don't know, Deb. I don't know if you'd have to do that. So, I mean, because you haven't done anything yet in which to pay the taxes on. You'd have to pay the tax obviously you probably want to withhold come October, so that way the IRS doesn't say, hey, you should have paid taxes on this. But I don't know why you need to do that from the front end. However, I'd pay, taxes. I think I send a check via electronic once a month to them, just because last year I got hit with a $500 penalty, and it wasn't that big of a deal. But I don't want to be hit with another penalty, so I give the IRS probably more than I need. Just because I'm simple. I'm a simple man. I'm just a caveman. Remember those commercials? I'm just a caveman. I'm a simple guy. I just say, look, let the IRS get his. I'll get mine at the end, and I pay them up front. So Debbie, knowing that maybe you and I have talked at one point, wink, wink. I would probably do what you're thinking just to get them off your back later on. but you don't have to. But it's probably not a bad idea. Smash, right on. Way to go, Tina. Bruce. Bruce is my hard charger. He's gonna come down there with a hockey stick and hammering people. Great picture of me and my munchkins. Yeah, right on, man. Enjoy the time they grew up, man. Ain't no lie. Damn. It's crazy. My wife just sent me a picture when they're just when we were going. My oldest daughter, she did these Army camps, GEMS camps. I forgot what they're standing for. One was in Vicksburg. Just seemed like yesterday. And she showed me the picture when we were going to Vicksburg. It was like 5 years ago. I was like, damn, dude. It's crazy how small they were. They went from Vicksburg. They got USAA, took them to their AI department at USAA. We went from Vicksburg to San Antonio. It was just awesome. It's just awesome. And I'm just looking at these pictures of them and so small. And now my oldest is now in Europe, freaking traveling, living like a freaking king, where her parents are living like paupers. What's up with that? Happy Father's Day to you, my friend. Heritage Farms, Texas, right on. I would pay estimated tax on an account conversion before January 15th. Yeah, okay, there you go. Vic. All right, Vic, man. I don't have any qualm. I don't know. That's a good point, Vic. So Vic says just pay it by essentially by the next quarter, or I guess the next filing. I don't know, but that makes sense. Vic says I pay the estimated tax by January 15th of the following year. The irony of it all is the IRS makes it very easy to send them money. You just put your social in there. You put your tax year you want to send them money. You link them up to your checking account, done and done. Very simple. And then obviously keep the receipts. My man Adam says, top of fees, I'm paying 1%. Oh. My man Ab says he's paying 1% fee. Should he keep paying that or run screaming? Yeah. I don't see the value, man. I just don't see the value in Adam. I mean, look, I don't think you should. I would rather. That's a freaking lot of money you're gonna be paying over time. I'd rather you pay the front end commission. Without question. If all these guys are doing is investment management, I'd much rather you have a good Ed Jones, pay them a 2.5% up front and buy a bunch of A-share American funds and be done with it and never blink your eye again, than paying a 1% fee year over year over year over year. There's no value added there at all. And I could give two craps what the industry is trying to use. Studies from Vanguard and Morningstar, the financial advisors can give you a 3.5% alpha. And what they're saying is we can outperform with tax planning, with all this other crap we're doing. It's all smoke and mirrors. There's no evidence of that whatsoever. I mean, you can freaking torch the data to make it confess to anything, and that's what they're doing here. Because Vanguard knows, they gotta appease the financial advisory business because we're putting tons of money into their ETFs. They know that. If you ask Jack Bogle, he would never agree to those kind of studies ever, because he says there's no benefit at all an advisor charging 1%. Not to the extent where we can say you pay us 1%. And this is what I saw a couple guys on on their blogs. You pay us 1%, essentially you're going to get 3.5% back. That was the insinuation. They didn't state that explicitly, but that was the insinuation. You're paying us 1%, but we're going to give you 3.5%. I about freaking puked all over the screen here, man. I was like, you can't say that. It's freaking nuts. Don't pay the fee. Rochester, New York, the old Rochester Amherst. Yep, index funds rule. I couldn't agree more, man. I could not agree. Can you still get into Vanguard Wellington? I think you can, Dennis, as long as it's the Admiral shares. My understanding that's above $10,000. I've had a couple guys get into it, and ladies, since then. Since they closed, but I think it's got to be the Admiral shares, and you got to do it at Vanguard if memory serves. Any suggestions how much one should leave in their pre-tax accounts when they retire, or should they try to roll all their money into a Roth? Tina's so much going on there. There's tons of suggestions, but in terms of being applicable to you, just got no more. Remember, if you're married, you want to take advantage of the tax code that's there today, because you're going to be in a higher tax code in the future. There's just no two ways around it. If you're single, it's different. If you're married, though, you're going to be in a higher tax bracket in the future. That makes sense, because you're going to die, or your surviving spouse, or you're going to your spouse will die and leave you as no longer married couple. And by the way, there's no qualifying widower. Well, I hear this all the time. At your death, people think I'm a qualifying widower or widow. That means I can carry married filing jointly tax filing status for the next 2 years after the date of death. No, you can't. And not unless you're caring for, I think it's a 16-year-old or younger child. No, you can't. So you're going from married filing jointly until the year of death until single tax status, which means you're paying more tax. And all that else that goes with that, as I said in my book, right? I told you about this book a couple million times, Tax Bomb in Your Retirement Accounts, all laid out for you there. Buy that puppy. Robert, I'm conflicted. I prefer stocks and 401k because I lose money than less taxes. Roth and money market because I hate to lose tax-free money. No, it's not correct. Robert, no. It's not a correct way of thinking, man. We want your Roth to take advantage of the tax-free growth that our government gives us. And we want your 401k to have no stocks in it if we can avoid it, if you need to look at it like that. But the reason for that is because money that comes out of a 401k is coming out of taxes, ordinary income. All right. So you're giving the IRS this huge lien on your property, because if it grows from 100 to 200 and it comes out as ordinary income at 200, you're paying 35% of that $200 as ordinary income. So for you, it only grew from 100 to 165. You took all this risk of getting it to grow from 1 to 200, but instead you're only getting 65% of the gain because the IRS gets part of it. Nah, don't do that. With a Roth, you're taking all the risk and you're getting all the gain. Nah, no, don't want that. So spineless, so slave. All right. Vic, yep, right. Yep, right there. Shameless plug. Vic is my publisher, I guess. Bruce is my my muscle, and Vic is my publisher. I am 70 and my wife is 60. I'm retired and she will retire in 2 years. When she retires, which one of us? Yeah, that's a good question, Peter. Rob W. Had to bring up the Bruins. I was going to say something about it, but how the hell does Brad Marchand, with 6 seconds left in the first period, skate off the ice for a line change? I love Marchand, but how do you do that? How do you skate off the ice when the puck is going into your zone with 6 seconds left in the period? I think it was, 6 seconds. I sat there and that was a game. We all knew that. It was a game after that. And we could have been down 1-0 and came back. But that was 5.2 seconds left in the first. Damn, that's pain. I tell you, why? I don't know why I get so uptight about sports. It's painful to me. It hurts. It hurts. I'm not going to lie to you. I love it and I hate it. It's a love-hate relationship. Of course, just like when I went to the freaking Winter Classic, my daughter, the Bruins laid a big fat egg. They scored 1 goal when they're already down 5-0 or something like that late in the third period. It's like, dude, this sucks. Wish they could at least scored a goal to make it interesting. Hey. All right. Peter says, should I convert mine or my wife's? I'm 70 and I'm 60. I haven't done any studies on that or seen any studies that said either or. If you're leaving it all to your wife and she's leaving it all to you, I don't think it matters. I'd be interested if anyone comes across a study that says otherwise. I haven't seen it. I haven't done a lot of research on that, but I frankly don't think it matters that much. You're going to have to take RMDs anyway, so you're not getting around that. So, Admiral shares instead of CDs on I'm not sure. I'm not sure what that fund is. The VF, it's a Vanguard fund, Admiral, so I get that. I just don't know what it is. The Roth conversions required estimated tax payments. Edward Jones says the fees at Ed Jones are fairly high. Are they worth it? Not front-end commissions. No, I don't think so. I have no problem with front-end commissions. I would never pay Ed Jones to have a managed portfolio. I just tell you that right now, no way. But to get American funds at front end, like you said, 2.5, depending on how much money you have in there, I got no qualm with that at all. I'm just thinking, if you bought an American Funds, the Income Fund of America in 1995, and you put $50,000 in that puppy, and you paid $1,250 in cash, I mean, you're never paying another commission. Now, there is what's called a trail, a 12B1 fee, and that sucks. But still, you're paying all of 60 basis points all in. That's a fantastic investment. That's a fantastic investment. A hell of a lot better than being in a managed account paying 1% a year on an account that's accumulating in value. Yeah, I don't know about the estimated tax payments, man. I've heard both, Bob. I never used to recommend people doing that. I'd never had to when I did it myself, but times change. I had a lady, she told me she got an estimated tax bill, or not a bill, a penalty of like $100 a few years back because she did not pay estimated tax on Roth conversions. That's the first I'd ever heard of that. So I don't know. So I'm gonna plead ignorance there. You got Adam. 401k, small Roth 401k. I don't have an IRA. Is there anything like converting my 401k money to the Roth 401k? Yeah, absolutely. I mean, it really depends on your tax bracket and all that stuff. Married, filing jointly, Matt. But sure, absolutely. If your company allows you to do that, it's all based on the company. Do they allow you to do that? Yeah, right on. Please smash that link. But yep. Line 1 did nothing against the Blues 5. I know. In fact, the Bruins relied on the power play, and we died. Looks like okay, so a duration of 2 years, so rates move up to exactly. So Gary, right on. I mean, why even mess with duration on an account that's yielding the same as a CD? I would don't do that. Here comes Chenerjeev Patil. Hi from Southern California. Is there a suggestion for Charles Schwab? Yeah, I like the Intelligent Portfolio Schwab. I think it's great. I'm a big fan of it, but they keep 6% cash. Man, cash is a freaking asset class. I don't get why everyone's against that. I got no problem with the Schwab Intelligent Portfolios. I did a video on it last year, about over a year and a month ago or something like that. And I'm a huge fan of the Schwab Intelligent Portfolios. All right, my friends, looks like we hit the bottom of this. Much obliged for y'all being here. And again, sorry to you all who came late. That was my fault. I will figure out how to fix that so I get so I don't leave you hanging on the other end for 21 minutes like my man Ross did. That's not good on my part. I appreciate you still jumping on board here. And again, sorry for being late. Do spouses have their own RMDs? Or can retirement accounts be? No, everyone has their own RMD, man. Everyone's got their own RMD, Jerry. Absolutely. Thanks for being on board, Vic. Thanks, Bruce. All y'all came on board late because you're on the other side. Again, my apologies. We'll try to fix that next time. Hey, thank you, guys. We'll see you. Happy Father's Day to y'all, too.